I still think there's a little bit more downside in gold. I could see us coming back to about the 2200 area, give or take, maybe even a little bit lower. But I do think eventually on the next leg up, we take this area out. And I do have an upside target. End of year was 2500. That was my target when we started January. I think by 2025, the first half, we're probably at 2800 on gold at that point. If you see the Federal Reserve having to come to the rescue again in a downturn in the economy and basically building their balance sheet higher and lowering rates and making money free again, it all has the impact of making gold more valuable in terms of US dollar.
In a volatile trading session on Wednesday, the US dollar recovered ground lost earlier, following a series of high-impact economic events in the United States. This resurgence in the dollar's value occurred even against the traditionally safe haven asset, gold, as market participants exhibited a risk-averse sentiment. Gold experienced a significant bearish drop, falling below the previous day's low of $2,311, which signaled the formation of a bearish flag pattern over the past few days. Resistance for the day was observed at $2,327, lower than the previous day's high of $2,342. Gareth Soloway, chief market strategist at verifiedinvesting.com, forecasts a short-term downside for gold, potentially dropping to around $2,200. Despite this dip, Soloway remains optimistic about gold's long-term prospects, predicting a rise to $2,500 by the end of the year and $2,800 by mid-2025. Gold's recent performance has been remarkable. It touched an all-time high as a combination of fund buying and speculation over a potential Federal Reserve pivot, along with ongoing geopolitical and financial risks, fueled its rally. The precious metal has climbed more than 4% since Thursday, driven by expectations of monetary easing, geopolitical tensions, and the risk of an equity market pullback. Soloway attributes the potential rise in gold prices to several factors: ongoing U.S. deficit spending, high interest payments on the national debt, and possible Federal Reserve interventions in response to economic downturns. He also cites geopolitical tensions as a significant driver of gold prices in the coming months. Meanwhile, the silver market has been experiencing considerable volatility, reflecting the broader economic uncertainty. The market remains indecisive, with the economy in flux, leading to struggles in establishing a clear direction. Despite this uncertainty, the silver market maintains a generally bullish outlook. Soloway mentions he is looking to accumulate positions in silver again, particularly around the $28.50 and $25.50 levels, based on technical analysis. Join us as we delve into Gareth Soloway's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
So gold today had a relatively weak day. Considering the drop in the dollar, it was on the weaker side. It only eked out a small gain. I do want to show you something that I think is so cool. So if we take a look at this longer term chart of gold and what we do here, so we're going back to the 1980 high of gold. And then if we connect it to the high of 2011, look at where this trend line goes. This is one of the coolest things about charting, is that if you take this line, you literally come right up to this level, right? So now that I zoom in, look, we've pierced this level, but we're struggling here on gold. So you have to respect that trend line. Again, a trend line that goes back 40 plus years to 1980 is a powerful trend line. Now, having said that, what that tells me is in the near term, I still think there's a little bit more downside in gold. I could see us coming back to about the 2200 area, give or take, maybe even a little bit lower. But I do think eventually on the next leg up, we take this area out. And I do have an upside target. End of year was 2500. That was my target when we started January. I think by 2025, the first half, we're probably at 2800 on gold at that point. Unfortunately, more of the same. I think the U.S., to me, it doesn't matter what president is in the White House. I think once a president is in the White House, they tend to just want to make sure everything makes them look really good, which is generally spending money. We haven't seen any of our politicians have a backbone in stopping the spending generally again. So for me, it's that deficit, which now interest payments are now north of $1 trillion alone. With higher interest rates for longer, those interest payments are only going to go higher because we have to refinance our debt as it comes due. And then as you see all of that going, if you see the Federal Reserve having to come to the rescue again in a downturn in the economy and basically building their balance sheet higher and lowering rates and making money free again, it all has the impact of making gold more valuable in terms of US dollars. And I think you throw in any of the insecurities of Taiwan, China, all these other things, that just is extra fuel on the fire of gold. And I do think physical assets are going to be a place to be along with Bitcoin. It's been a great run thus far. I do think silver has a pullback. One area, so I'm looking to accumulate myself. I haven't had any silver positions recently since this move to the upside, but I have a couple levels. One is going to be around the 2850 level. I get that level on a technical basis by connecting these lows right here. So we're getting close to that first add level where I'm going to start to accumulate. And then the big level is going to be right here, folks. And if we look at this, right, and we look at this trend line here, we take the high and we stretch this to this high through this high. And this is what we call a retrace to the scene of the crime. It's back at around $25.50. That would be where I load a majority of my stake in silver should it get there. Now, remember, there's always a chance I miss the trade, but the greatest thing about being a trader where you trade crypto, stocks, and commodities, there's always another trade around the corner. So I've missed many trades in my life. I'll miss many more. I just need to catch a few. And if it comes back there, that's silver for me.
Economists are increasingly confident that the U.S. economy will avoid a recession this year. According to the May outlook from the National Association for Business Economics, 9 out of 10 business economists predict the economy will have a soft landing in 2024. This optimistic view has been bolstered by encouraging inflation data and the Federal Reserve's acknowledgement of progress in combating rising consumer prices. The hopes for a soft landing, a scenario where the Federal Reserve successfully curtails inflation without triggering a recession, have significantly fueled U.S. stock market gains this year. These expectations have been critical in driving the S&P 500 to record highs in 2024. However, Gareth Soloway remains skeptical about the Fed's ability to engineer this soft landing. Soloway argues that if the Fed's actions lead to a stock market decline, it could precipitate a recession, resulting in job cuts and reduced consumer spending. He emphasizes the Federal Reserve's challenges in managing the economy, particularly in controlling inflation and adjusting interest rates. Let's get back to the interview.
And there was a lot of uncertainty with Jerome Powell. He calmly talks about all of this, but the words that he uses is uncertainty, unsure about economics, about the economy, and as well as about how many interest rates are going to be needed to do cuts. So all of these things to me tell me the Fed is trying to land this plane smoothly, but they are acutely aware that there are many hurdles that they still have to go through. And remember, even with the CPI data coming in this morning better than expected, a lot of that was because gasoline and oil fell about 9% in May. And ultimately, we've already seen a 6% rise in oil just this month alone. And so again, you have to look at it and say the Fed still has inflation north of 3%. And they're now talking about cutting rates, but now it's only one cut. When does it go to no cuts? Maybe next year, even less cuts than they're saying as well. What I'm looking at here is now you have to look at the stock market, and the stock market continues to make new all-time highs. And I see literally zero chance that the Federal Reserve will cut rates until you see a significant pullback in the stock market. When we're talking significant, I would say it has to be at least 10%. So if we don't get a 10% pullback by year end, then you're not seeing the Federal Reserve cut this year. And again, look at it from this perspective: is the higher the stock market goes, the more inflation there will be in the system, or at least harder it is for the stock market to bring down inflation because of the wealth effect. Remember, everyone's looking at their 401ks, at least those that have investments. We know that the lower to middle income brackets are struggling. I mean, that is no change. We've known that now for months. The higher income, they have investments, and every day the stock market making new all-time highs makes them feel richer, and they go spend, and that creates a demand size movement where you're seeing more demand for goods, and that pushes inflation basically neutral to higher. I think that's the amazing thing about it. It's like a catch-22, right? The Fed seems like they don't want to actually put the kibosh on the stock market and really force it down. But if they don't force it down, then you're going to see inflation stay north of 3%, and it's going to make it almost impossible for them to cut rates in the future. The other side of the coin, too, is that this Federal Reserve intervention, and this has gone on now for decades, has literally caused this massive divergence between the rich and the poor, right? If you're rich and you have money to invest, then if you have a drawdown in the economy and people lose jobs, the Fed lowers interest rates, allowing those people to borrow money. It pushes the stock market up even more. if the economy is strong, then they raise interest rates, and you talk literally about hundreds of billions of dollars in interest payments that are now being made to these high income individuals, making them richer, while the lower income are struggling to afford the inflation at McDonald's to feed their family. So again, this has been from the very start one of the worst scenarios. It all started, in my opinion, with the dual mandate. Once the Fed had to be concerned about employment plus the banking system, that's where honestly this began. I've always been a doubter. I've been a non-believer in the Fed. Historically, the Fed does not have an accurate, track record of engineering these soft landings. And really, if you look at it, it's they're in a hard place. I mean, I don't envy their position, even though it's somewhat self-made. But ultimately, I don't see how we get out of this without some sort of corrective move. And by the way, if they cause the stock market to come down, you're going to see a recession, right? That's going to cause businesses, Apple's, the Googles, all of these companies that still are already cutting jobs, they're going to have to cut more as consumers pull back. And I think one of the things to keep in mind for people is you have to look at the tea leaves, right? We've seen the latest earnings come out. We saw Starbucks, Disney, Expedia, traveling. A lot of these areas are starting to see the consumer pull back just a little bit. You still have the high-end consumer willing to spend, though, and they are keeping this economy on life support at this point and spending enough to keep the merry-go-round going. But if anything happens to that stock market, you will see the higher end start to pull back as well, and then recession follows very quickly. So no, I don't think the Fed engineers a soft landing here.
As we navigate these uncertain economic waters, the interplay between gold, silver, and the broader economy remains a focal point for investors and analysts. Will gold and silver continue to serve as safe havens amidst economic uncertainty, or will the strengthened U.S. dollar and potential economic shifts alter their trajectories? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.